We are having this special conversation with the top team at Nomura, Sonal Verma, Vivek Rajpal and Neeraj Gambhir, to talk about where we stand as far as the economy is concerned and what are the factors which the investing community on the institutional sides is watching out for. Gentlemen and the lady, thank you very much for joining us today on ET Now. Sonal, let me start with you. You guys are just back from your regional investor conference in Singapore. Talk to us about broadly, as far as the Indian economy is concerned, what were the kind of nature of queries investors were posing at you? There's a lot of talk about macro worries at the horizon. How did you measure those while your conversations with them?
You're right. I mean, I think at this stage, the focus is essentially on two key things as far as India is concerned. One is global macro risks and their impact on India. So the impact of higher oil prices, the impact of rising US rates, what it means for capital inflows into India. So India being a twin deficit country is sort of standing out in that regard, and investors are concerned on the macro side. But the second focus has also been on the political cycle, given the upcoming elections next year. There's also a lot of interest on how things are on the ground, what are the potential options next year. So yeah, quite interesting to see the macro and the politics sort of focus coming clearly back to India.
So is there a possibility or concern in the minds of the investors that this year the political scene could actually take center stage in terms of policy making, and also give us a flavor on how they are analyzing the first 4 years of this government as far as the reform work done so far? Do they feel that it is bearing fruit in terms of infrastructure creation, getting growth back, triggering buoyancy in the rural side of the economy?
I think the overall assessment, I would say, for the first 4 years is surely on the positive front. On the growth front, I think everybody sort of recognizes that the growth impulse right now, to the extent it's coming in, is coming in because of government spending on things like roads and railways, etc. So the order book that companies are seeing is coming primarily from these government-linked infrastructure projects, and because of rural roads and this, rural electricity projects, we are seeing rural consumption as a theme story as well picking up. There's also a lot of optimism still, I would say, around goods and services tax, and there is at least hope that GST collections will pick up over a period of time. So yes, I think the overall assessment for the 4 years has been positive. In terms of forward-looking outlook, I think there is a bit of skepticism given this is a pre-election year, and given the given oil prices moving up, there's a fear that the government might slip on the fiscal deficit front, although I don't think that's sort of a given at this stage.
Right. We'll get back to some of the factors which you briefly touched upon, but Neeraj, rising US yields is a topic which has been an area of concern for emerging markets, at least first half of this year. How legitimate is that risk? And because you have not seen it or analyzed it so deeply for emerging markets for a long time, how worried should India be?
So it's a very important consideration for most of the investors, because as you rightly said, we are seeing a uptick in the interest rates globally after a very prolonged period of easy monetary policy. And in some senses, the market has gotten used to very high amount of central bank liquidity being provided. Now, as slowly the central banks unwind their balance sheet, Fed is already on the path to do that. ECB has announced a taper. So I think as this liquidity gets withdrawn, there will obviously be consequences in the global markets, and investors will need to be prepared for those consequences. The only redeeming factor at this point in time, as I would basically think, is that it feels like that we are not at a situation where emerging market economies are extremely weak. I think most of the emerging market economies are doing reasonably okay, and as long as these changes are well telegraphed and the markets have a chance to prepare for them, hopefully the damage may not be that significant. But at the end of the day, every central bank will be watching out for implications for these changes, and kind of preparing themselves for the consequence of these changes. So I think there is a need to be sort of vigilant and cautious. I don't see a big concern here per se.
Sure. And how do you see India's preparedness for now, events like these? In fact, ECB also did say they would not like to, they'll go slow because they want to take into account the liquidity requirements of emerging markets as a whole. So do you think we are much more robust now, no longer fragile 5?
I think the immediate comparison tends to be with taper tantrum. And at the time of taper tantrum, when Fed first announced their, their intention to sort of roll back the easy monetary policy, we are certainly at a much better space at this point in time. Our current account deficit to start off with is just about 2%. Economy seems to be doing much better. We are at about 7% growth rate, give or take, and our inflation seems to be fairly under control. Our fiscal balance is also kind of okay, though one would have liked to see it a lot better than now. So I think overall, from a macro fundamental standpoint, India seems to be at a much better place. But can we completely avoid it? I'm not too sure of that.
Vivek, we were just talking about how the street, this time the reaction, be it on the money market or even the equity market, looked much more mature as far as the rate hike and the commentary and the stance is concerned. How did you analyze it, and how do you see things go from here on? Clearly the rates seem to have troughed out, but are we more prepared about it now?
Well, I mean, to be fair, if you really think from a market perspective, yes, at least onshore markets were telling that there will be a rate hike, and RBI actually delivered rate hike. And I think, as we were discussing earlier, market didn't take it negatively. And I think this is pretty important, because what market now understands, especially after the taper tantrum episode, is that a real yield cushion may not be bad for India. And from that perspective, if RBI is acting preemptively, if RBI is responding just not to the headline inflation, but to the details, it's not necessarily negative. And to, I mean, if you come on the local factors, if you really see, most of the front end bonds or the money market rates were anyways kind of pricing in hikes, and in a way what RBI did was just matching the expectations, and hence it was not disruptive. Typically a disruptive hike is when it comes as a surprise, and I think it's the maturity of the market as well as the valuations which provided the comfort.
You know, one thing out of the RBI commentary this time which stood out for us, many of us actually, was the way they spoke about capacity utilizations in the system and growth, of course, coming back. That was a bit reassuring. How did you analyze it, and do you think we'll live with 8% kind of yields now in the system? A lot of wholesale lenders we speak to at ET now seem to be not extremely perturbed about it.
Well, I think there are worries, to be fair. There are worries that the price of money has gone up higher than it should have at this stage of monetary policy cycle. But I think what was really reassuring from Reserve Bank of India monetary policy meeting was that they kept their stance neutral. And their stance neutral effectively suggested that they will be much more data dependent than has been in the past. I think one big difference in this hiking cycle versus the previous hiking cycles will probably be this will be a much more shallower hiking cycle, let me put it this way. And to a certain extent, the valuation in the bond markets are already pricing in a certain level of terminal rate expectation, and hence RBI taking a neutral stance was taken positively by many in the markets. I mean, is 8% the new reality? I think 8% is the new reality, and we'll be pretty much range bound for time to come. But I mean, there are some pockets, there are some worries as far as the price of money is concerned in the very front end. Hopefully Reserve Bank of India will take some measures to iron out that worry.
So in fact, my next cue actually comes from his answer. Recently, we were just reading a report that what is also worrisome is that on the one hand, risk-free rate, which is also indicator from yields, is rising, but the reason why investors should put money into India, the earnings, the economy growth is relatively on the lower side, and hence makes market valuations very expensive. That was one of the arguments which was being talked about by a note. How do you see the speed of rate hikes going up from here on, and even the commentary from RBI, versus the growth which is catching up in the economy?
I think near term the indications are that growth will be fairly strong. So, the March quarter we had a 7.7% growth rate, and the next quarter we think will continue to be a fairly solid 7.5 to 8%. But I think incrementally there are certain worrying signs on the growth front. I mean, the fact that oil prices have moved up clearly means that disposable incomes are starting to get hit, and therefore consumer discretionary side might actually start to slow down. Similarly, Reserve Bank moving is one, but the fact is that market interest rates have moved up substantially. And therefore, from the aggregate system perspective, conditions have actually tightened in terms of the aggregate financial conditions. So typically these factors will have some adverse impact on growth, and there tend to be lags of probably 9 to 12 months before we see this. So the near term growth outlook is still fairly solid. But some of these signals are suggesting that there would be some moderation in growth 12 months out.
Okay, so you're saying that they may actually come with a lag. So second half of say FY19 is where things may slow down because this will start catching up?
Yeah, I think on an aggregate basis, much of the growth is going to be front loaded. Okay. So yes, second half, our expectation is that there will be some moderation in economic activity. But within that aggregate picture, I think it's also important to look at the differentiation in terms of what's driving growth. So, the rural side of the economy might continue to do well. Government spending on specific projects on the infrastructure side might continue to do well. With rupee depreciation and US economy likely to do well because of the fiscal stimulus. So segments that are more linked to that might continue to do well. But on the discretionary side, on the private investment side, clearly things have been a bit on the weaker side, and that in our view might slow down a bit further.
In fact, data also shows that crude product consumption in the month of May has fallen after almost 8-9 months, and demand destruction is actually happening. But how are you also reading indicators, high frequency indicators to gauge consumption in the system? Do you think consumption is healthy right now, and what are the trends you see on the consumer side?
As we speak right now, I think both urban and rural consumption indicators are suggesting very strong growth. In fact, if inflation has come back, which it has, core inflation, it is clearly a signal that certain companies in certain segments have been able to pass through their input cost increase, which would not have happened if consumption demand wasn't strong. So I think consumption is very strong right now. Okay. But like I said, with interest rates starting to move up, with oil prices moving up, fuel costs going up, clearly disposable incomes are going to slow down. And therefore, government spending related rural consumption might still do okay, but on the discretionary side, there might be some slowdown going forward.
Yeah, the other thing which has been area of focus at least first 6 months, and I would like your opinion, how do you see the medium term, is the flows in the bond market from the FII side. In fact, even in equity market, foreign flows have been negative. In a rising yield scenario, mainly from from developed markets, how do you see flow picture on flows pan out in India or even some other emerging markets?
So if you look at India from a valuation perspective on bond market side, it certainly looks pretty good, okay, right? 8% yield with the real yield of approximately 2.5%, right? If you take a combination of government and corporate bond yields, it looks quite attractive. The challenge is that we are in a system where the overall emerging market flows are themselves impacted, right? And we are a part of a larger EM sort of flow dynamics stroke picture. So if that continues to be challenged because of a variety of reasons, it's very hard to imagine that India will continue to get positive flows. We might be less impacted than the others over a longer period of time, but in the short run, I think the impact will be there. Having said that, I think what we have seen, and we've seen this in taper tantrum time as well, is that even though there are flows out of the economy, if you look at the aggregate amount of such flows, it's not really a very large part. The good thing or the bad thing, whichever we want to look at it, is that bond market today does not depend upon foreign flows. Only about 5% of our bonds are held by foreign investors. So I think it's still a very large domestic story in that sense.
Vivek, what are your thoughts on the rupee, the way we went almost to 68? What is your numbers telling you about the levels to watch out for and the factor that play on rupee?
So I think what India has seen is one round of repricing in most of the fixed income asset classes, and that repricing, one of the big reasons for that repricing was the rise in crude prices, and which is one of the reasons INR underperformed. So on one hand, India is highly sensitive to the oil prices. On the other hand, it is probably less sensitive than the other emerging market currencies as far as US rates are concerned. I think at a broader level, ultimately how the emerging markets behave, or how the dollar in the emerging markets behave versus the emerging market behaves, will be the key driver of INR. I don't see a reason if oil is stabilizing, I don't see, and activity data in India is picking up, I don't see a reason why INR should underperform from here. If anything, INR will likely consolidate around current levels. But will I be significantly bullish on INR? Will largely depend on how the global factors play out. At this juncture, with broad dollar rising and emerging market stress still there, I think it's reasonable to expect some consolidation around current levels. So definitely not underperformance, but consolidation.
So you think that roughly the run rate of 5% weakness versus the dollar over last, say, 1.5 decade, that run rate would continue, or where would it settle in the medium term? What levels?
No, I think forwards are pricing in higher depreciation. So from that perspective, INR should not beat the forward. I think it should still be weakening at much less than what forwards are suggesting.
So let's shift focus to one of the areas which is the focus, global focus now, is trade wars and the way that historic Singapore summit panned out. What were your observations? Though we are not a very large global trader right now, but our trade data is also kind of on the weaker side. What are your thoughts on these two?
I mean, the summit for now has meant that the geopolitical tensions are at bay. Whether they are permanently resolved, only time will tell. I mean, the US-China trade friction is something that's coming back into focus. And while the focus is a lot more on the impact this is going to have on US and China, the fact of the matter is that China ultimately is sort of more of an assembly center. And our view is that if there is increased protectionist measures against China, then the real impact will actually not be on China, but some of the other open economies in Asia like Taiwan, Korea, Singapore, Malaysia, which actually end up supplying some of the raw material to China, which then moves and which meets the final demand that's sort of outside China. So there's an impact to the open economies within the region. But I think in general, if you're moving towards more trade protectionism, we're talking about world trade growth actually potentially slowing down, which is a risk. Because if India really wants to grow at a fast pace in an environment where global trade is not going to grow very fast, then the focus has to be a lot more on generating domestic demand to be able to sustain a high growth. And I think that's the biggest policy challenge we face today.
So out of the growth estimates which are out there on a broad consensus manner for India, how much of that is actually purely domestic reason or factor led, and how much of that is get a rub-off effect from improvement in global growth in your view?
I mean, incrementally, I don't think there is an expectation that global growth will drive domestic growth, so the aggregate growth. So I think much of the expectation of positive growth in India is more domestic than global. Having said that, I think the depreciation we have seen over the last few months could potentially lead to net exports contributing a bit more to growth going forward. But on the whole, it's more of a domestic demand, more consumption, more public investment that is more likely to drive domestic growth. Yeah.
All right, guys, on that note, we'll let you go. Thank you very much, Sonal, Neeraj, Vivek, for joining us on this very interesting conversation that we had.